indices are reacting to what's happening in the markets, but maybe not as much as expected.
Welcome back to Let's Talk Forex. I'm Chris, and as always, I'm joined by Alison. Hey, Alison.
Hey, Chris, how are you doing?
Yeah, I'm all right, thanks. I'm all right. I'm off to London tomorrow to a cold, damp London. Yeah, getting out of Portugal.
At least you've had some sunshine in the Algarve, hey?
Yeah, no, I was down on the south coast. That was really nice, and it's sunny here too as well. It's not quite as warm as it was in the Algarve. But yeah, no, I've been lapping up the sunshine. Now I'm going to London to pay my penance for having too much fun in the sun. Gonna go get dunked on by the British rain. No, I do enjoy London. I like going back to London. I don't want to live there anymore, but it's nice. It's nice for a week or two. So I'm looking forward to it. It's going to be good. How you do?
Yeah, fine. I can't complain. No wind, beautiful weather. Yeah, winter hasn't quite hit. It's dark in the mornings. That's what I've noticed. And it gets darker earlier at night. But other than that, yeah, pretty idyllic, really.
What time does the sun set? Like winter solstice? How early does it get dark?
Like it starts getting dark at about 5:45, sort of 5:45. After work I can usually go around, but I've seen now it gets a little bit darker a bit earlier, so it's a bit more difficult.
Not as bad as London though. Where we get middle of winter 3:30 and the sun's gone.
It's crazy.
Yeah, bleak.
Yeah.
But again, this is why I live in Portugal.
More sunshine, yeah.
Yeah, more sunshine. Anyway, what are we talking about today, Alison?
Well, today we're going to be talking about how to trade indices, and we're going to be talking about how it works and then how they're different from cryptos, currency pairs, and stocks. And we're going to also talk about how you can build, effective strategies around indices trading.
Yeah, exactly. But before we get started, I just want to give a big shout out to our listeners and subscribers in India. We've seen your comments, we've seen your support, and we're very grateful. Not that we're not grateful to everybody else as well, but this week, particular shout out to our Indian community. Thanks so much for tuning in. Right, Alison, so let's start with the basics. So what are indices? So an index, or indices in the plural, are a group of selected stocks that represent a segment of a market.
Yeah, exactly. So, for example, you get the S&P 500, probably the most well-known index, and it's basically it tracks 500 of the US top 500 companies, and you also get the FTSE in the UK, which covers the top 100 companies on the London Stock Exchange. So it's basically a snapshot of a country's or a sector's stock market and what they're doing.
Yeah, so unlike Forex, when you trade currency pairs, of course, with indices, you're trading the performance of a market, of an overall market. It's quite a different thing.
Yes, it is. And unlike individual stocks, you're not betting on one company's success or failure. So you're trading the broader economy or sector, I guess.
Yeah, exactly. So let's have a look at the main differences between Forex and indices. So with currencies, you're always dealing with pairs, right? So you've got the euro versus the USD, right? You've got the yen versus the pound, et cetera, et cetera. All these currencies are relative to each other.
Yeah, and of course, the Forex market is open 24 hours a day, 5 days a week. But most indices follow these local stock market hours. So you are going to be trading them, at the London Open and the London Close, or the New York Open and the New York Close. Although, of course, CFDs can be traded 24/5, except the DAX. You'll find that the DAX does close.
But indices also tend to be less volatile than currency pairs. But when they do move, it's often tied to macroeconomic data or major corporate news, major corporate events.
Yeah, exactly. And another major difference is that Forex markets are extremely liquid, and they're heavily influenced by central banks. So obviously, interest rate announcements will affect it, and CPI, all those types of announcements will affect the Forex pairs, whereas indices are more tied to corporate earnings, and they're also tied to interest rate policy in a slightly different way, obviously because it affects the borrowing of those companies, and also investor sentiment about the economy. So it gives you a little bit of a broader view of the economy.
Yeah, exactly. I mean, it's like what we're seeing right now, with the Moody's downgrade in the United States, where they downgraded the US debt, where it lost its AAA rating, and you'll see stock markets fall, and this is a sign of investor sentiment about the wider economy. But what about commodities? I know a lot of Forex traders also trade commodities, like gold and oil. I mean, how do indices compare?
Well, they've obviously got different influences. So, they're influenced by obviously supply and demand, and then of course they're going to be, influenced by weather and of course geopolitics, like we've seen with gold recently.
Yeah, absolutely. And we also find greater volatility with commodities as well, especially during, like right now, with geopolitical tension. And there's also unexpected weather events or catastrophic events like earthquakes, etc., that can really send commodities for a wild ride.
In contrast, we find that indices produce more stable trends than commodities over the long term. So we find commodities tend to jump up and down depending on, as you say, the geopolitics we've seen with oil particularly, and of course the huge rise in gold, which was, I don't know if it was unexpected, but it's unexpectedly high. I mean, obviously indices are reacting to what's happening in the markets, but maybe not as much as expected, whereas you are seeing huge jumps in commodities at the moment, especially the safe havens.
And then there's stocks, individual stocks. These are the building blocks of indices. That's what indices are based on.
Yeah, I mean, when you trade an index, you're basically trading many stocks at once. So, there's kind of built-in diversification.
Yeah. Exactly. So if one company tanks, but the rest of the index performs well, then you're probably still going to come out on top, which I think is a lot of, one of the big reasons why people prefer trading indices rather than individual stocks.
Yeah, because with stocks, you need to obviously watch company earnings, you need to watch leadership changes, PR changes, whereas indices will smooth out that noise because one company is not going to make such a big dent, in something like the S&P 500, for example.
Yeah, exactly. So, I mean, I know we just mentioned there, but I mean, what are the other reasons why traders love trading indices so much, Alison?
Well, as I mentioned just now, diversification. So it's obviously lower risk than betting on one company. And also because they reflect the broad market trends, many traders use them to sort of express or feel out the markets, I guess. It gives you an indication of what's happening, in the broader economy, as we said earlier.
Yeah. And lots of brokers will offer really tight spreads, and offshore brokers will offer quite high leverage as well on indices. And so this makes it accessible to both beginners and to more experienced, more professional traders.
Yeah, exactly. And with CFDs and ETFs, can go long or short. So this obviously makes them extremely flexible. But I want to just focus on a question that we often get from traders, and that's which market is best for trend trading. So are you talking about crypto, Forex, individual stocks, or indices?
Yeah, that's a really great question. So when it comes to trend trading, the choice of market really matters because you're going to be holding a position for days, weeks, sometimes months. So you really want to make sure you've got that trend right.
So let's start with stocks. So many of the strongest, most consistent trends come from growth stocks. If a company is expanding, if it is posting good earnings, if it's gaining market share, then, its stock might trend up for many years at a time. If we think about Amazon or Apple since 2010 and the growth we've seen there, it's a good example of how those trends form.
Yeah, exactly. You can also see trends in commodities like sugar or crude oil. This is usually the case when supply and demand is imbalanced. So, I mean, you'll see this with cocoa, you'll see this with copper. When supply is constricted for whatever reason, you'll see a trend upwards. But they are more volatile commodities, and they can also be expensive to trade. So yeah, I mean, I'm not so sure here about if you're into trend trading, if you're into positional trading, commodities probably are not the one you want to aim for.
And then if we look at crypto, obviously crypto has been super volatile. We've seen these explosive trends. We saw the Melania and Trump coins jump within a day and then jump down the next day. So you have these huge explosive movements, but they're often jerky, they're news-driven, they're unpredictable, they're not based on anything sort of really fundamental. As we've seen, Bitcoin spikes up, then it dumps, and then it recovers in a few hours. I don't know. It's emotionally taxing for traders to trade crypto. So it's hard to say whether they trend or not. They can in some circumstances, but yeah, much more unpredictable and much more volatile.
Yeah, as you say, I mean, I wouldn't recommend it for positional traders. And then there's Forex, which is our bread and butter. These often range rather than trend. I mean, as we're seeing now, you tend to get short trends. You get these spikes. Usually accompanied by very high volatility, and but they can reverse quickly as well, as we've seen over the last few weeks. With the US dollar. That said, some exotic pairs or cross pairs do trend nicely, but you just have to scan, select carefully, educate yourself if you're looking to be a positional forex trader.
Yeah, and you really have to be aware of the news and geopolitical tensions. Yeah, on that note, where do indices fit in? We've sort of spoken about all the other assets, and they kind of fit right in the middle. They can trend strongly, especially during, economic recovery phases like we've seen recently. There was a short recovery phase in the S&P, but they're also very subject to macroeconomic news, central bank shifts, of course, and geopolitics. So, yeah, they can be volatile depending on what's happening in the world.
They can be, yeah, but I do say, like, compared to the other asset classes, I think probably if you're a positional trader, you're probably better off with indices. But the bottom line is there's no best trending asset here. You've got to identify what the current environment favors, and then find those clean trends and then apply your trading strategy selectively. Be very careful.
Yeah. So on that note, where do, what strategies work best for indices trading in your experience?
Yeah, so first up, I mean, as we were just saying, they're trend following. You use moving averages, trend lines. You need to follow momentum, especially during these long economic upswings that we had seen prior to Trump's election in the United States. Very good example. And then you can time your entries with flags and pullbacks.
And another strategy that we spoke about actually a few weeks ago are breakout strategies. So the open range breakout is a great strategy with indices. I know it's very popular with indices. And yeah, if you see an index making a fresh high or breaking a key level, this is often a time when you might find that the index will rally quite sharply. And, this also can be quite good around earnings season and major policy announcements. You might find really nice rallies on the indices.
And, with indices like swing trading is also really popular. You hold a position for just a few days just to catch short-term market moves. This is usually between support and resistance levels. So a bit, I mean, as long as you're aware there's no major economic news coming out or any major corporate earnings, this can be a pretty safe strategy as well.
Yeah, and then if we look at mean reversion, this is also a very popular trading strategy. Indices sometimes overshoot. They become sort of oversold or overbought, and often then you can fade a move. So you basically will bet that it'll return back to the mean because maybe it's become overpriced or underpriced, and that's of course where if you see signals that point to reversal, say a flash or a price exhaustion pattern, then you might want to trade a mean reversion.
Yeah, and finally, there's momentum trading. This is especially good after important news events. So if the market surges on great US jobs data, for example, you can ride that momentum, usually for a few hours and sometimes for a few days. In the case of the NFP, if it's a bumper NFP, the indices can really carry you.
Yeah, absolutely. And on that note, timing really matters with trading the indices.
Yeah, that's right. So this a very common strategy is getting involved the first hour after a market open, especially the US or the European markets. This is when you see the most volatility, the most trading activity, and you'll also see really sharp reactions to overnight news and economic reports, or and what's been happening in Asia, for instance, if you're trading in the US or the EU.
Yeah, exactly. And the close is also a very popular trading time. You often see volatility spikes here because, traders are squaring off their positions, or institutions are selling off their portfolios, or, repositioning for the end of the day. So the close is often a good trading time as well.
Yeah, many traders call this the power hour. It can offer great trading setups, but there's a lot of increased risk as well here, because it can be very unpredictable. So depending on your style, you may want to, depending on your risk threshold, you may want to get involved or you may want to stay out.
So you also want to keep in mind the trading sessions. So, of course, the London-New York overlap is a very active trading session, and this happens between 1 and 5 p.m. London time. And, this is obviously when volume is the highest. You'll have many indices like the S&P 500 and the DAX, and that's when you'll see them really start moving.
Yeah, exactly. I mean, much like the Euro USD, this is when most traders are getting involved. There's a huge amount of transatlantic trading in around this time. So, yeah, good liquidity and good volatility, and usually quite a few news events as well. So, really good time to trade. Yeah, so if you're a trend trader, don't just pick the right asset. You want to pick the right environment too. So, stocks and commodities are going to give you longer trends. Crypto, if you want drama, and you want to get white hair early in your life. But and Forex requires selectivity and education and discipline.
Yeah, but indices sort of give you a good mix. You get the diversification, you can find strong trends during the right conditions, and there are a lot of different strategies that you can apply to indices. As we were talking about mean reversion, swing trading, and momentum trading. So I think they give you a lot of opportunity.
Yeah, they do. They're you can see there's a reason why a lot of traders like them. Like trading indices. So that about wraps it up for this week's episode of Let's Talk Forex. Thanks for joining us.
Yes, and thanks so much. And if you enjoyed this episode, please remember to subscribe and like and leave a comment in the comment section below. And just a reminder before we leave, there will be a live session in 2 weeks' time on Friday. So please stay tuned for that.
Yeah, we'll put in a notification on YouTube just so everybody's aware. Yeah, that'll be a fun one. Looking forward to it.
Great. Cheers, Chris.
Cheers, Alison.